episode. Okay, and this is the second part of the order flow versus market condition, doing your top-down analysis, your top-down analysis the right way. Okay, so this is the second part of the video. So if this is your first time of probably coming across this channel, or if this is the first part, if this is the first video you are watching on this channel, this is actually a second part of the previous episode we had. Okay, so you can make reference back to the first part before coming to this one. Okay, so and if you have not subscribed to this channel, please do well to subscribe, turn on the notification bell to get notified when we upload our weekly content. All right, so with that said, let's get down to the business of the day. Okay, so now we stopped at the 1 hour time frame. Okay, I've been able to give us the trading plan. Okay, what to do, the step-by-step guide on what to do from the weekly time frame. Okay, then now we are at the 1 hour time frame. Okay, so this is what I want you to do with the 1 hour time frame. Okay, whenever you put up your chart on a Monday, okay, on a Monday, you are going to have a vertical, sorry, is it horizontal or vertical? It should be vertical. Okay, you're going to have a vertical line, okay, delineating your Monday's New York midnight open right here. You can see this is the 1st of August, which is on Mondays. Okay, so you can see the time here and the date. So we have midnight opening price. Okay, so I'm going to mark that out with a trend line. You're going to extend it out in time. Okay, so now what you are going to do, the first thing you are going to do is to identify displacements in the direction of your intended bias. Okay, in the direction of your order flow. So if your order flow for the week was bullish, you're going to you're going to look for you're going to wait for price to show displacement upwards. Okay, so you're going to watch out for displacement upwards. But if your order flow was bearish, you're going to watch out for displacement to the downside. Okay, so this is the displacement to the downside. Okay, so now once we have this sets your table for, this right here sets the table to start hunting for your setup. Okay, so this right here tips your hands off and offer you a setup. Okay, so once you have this, the next thing to do is I've already talked about the vertical line on the midnight opening, of course. Okay, and I've talked about extending it out in time. Okay, so now once we have this is just all you are going to do with the weekly, with the 1 hourly time frame. Okay, with the 1 hour time frame, there's going to be a vertical line, right? Your midnight opening should be extended out. Then watch out for a displacement, in your intended bias direction. Okay, so now let's go down to our next time frame. So now the next time frame is probably the 15-minute chart. Okay, so now what I want you to do with the 15-minute chart is the level of the displacement on the 1 hour time frame. That is going to be your drawn liquidity. This right here is going to be your drawn liquidity, because what we are seeing right here is expansion. Okay, so the market was kind of consolidating, right? It was moving sideways, then it created this expansion. So the next phase we are probably expecting the market to go into is retracement. Okay, so that, always remember one thing: what we are trying to capitalize on the market is always a retracement. Okay, we are not trying to chase the first expansion. Okay, we don't try to chase this move. Let me go back up. Okay, we don't try to chase this is not what we are trying to capitalize on. Okay, this right here is what sets the table for our setups. Okay, is what tips us off that a setup is about to come up, that we're about to have a setup in the market. Okay, so we are not trying to cash this move. Okay, we are more or less not interested in this, but we are only using this to frame our trade. Okay, to frame us a setup. Okay, so what we are trying to capitalize on is this move right here and this move down. Okay, so in this case, in this example, we're having a bearish trend, right? So I'm watching the market to see for this kind of displacement. Okay, so what I'm actually saying is consolidation, consolidation, which is the market being in a state of equilibrium consolidating. Then we have consolidation, using the what's it called, the IBDA, interbank price delivering algorithm concepts. This will be viewed as consolidation, expansion, retracement, and expansion one more time. Okay, so we are trying to capitalize on, this move and this move. Okay, so the retracement and the next expansion going down as a continuation of that particular trade. That is what we are trying to profit on. Okay, so you can either get a setup from this move, or you can get a setup from this. Okay, if you are able to get both, that's fine. Okay, so but the idea is that we are not trying to chase this, we are not trying to predict this, we just let this move happen on its own. Once this move happens on its own, once this happens, that sets us up for our setup. Okay, that is just it. There's no two ways about it, guys. This is just what, knowing this alone will help you filter lot and lots of trades. Okay, that is where timing and patience comes in. This is where timing and patience comes in, because this is going to take a while. It might not happen on a Monday. I didn't delineate the days. Okay, I didn't delineate the days, but you can probably pull up your chart and look at it. Okay, when this move happen. Okay, this could probably take, maybe it could probably happen on a Monday or a Tuesday. Okay, so that is where timing and patience comes in. Okay, I see most traders trying to get a setup, every, they try to get a setup to get in the market every day. Okay, that is just something you want to avoid. Okay, so intraday trading, intraday day trading is does not mean, does not actually mean trading every day. Okay, you can just be, if you are patient enough. Okay, trust me guys, if you are patient enough to wait for this kind of move to happen, you are going to get huge risk to reward ratios. Okay, you're going to pull up trades that are going to offer you huge rewards, huge returns. Okay, you're not going to be looking at a minimum of 3 to 1 anymore. You're going to be looking at something like a minimum of 5 to 1, sometimes 8, sometimes even more. Okay, I have put off trade in a BTC, in BTC USDT on a crypto market where I had a 19 to 1 risk reward ratio. Okay, trust me guys, being an intraday trader, you can actually turn it into swing trading. Okay, you must the concept of intraday trading is to close our trade within a single day, but when you are patient for, and you watch out for this kind of move, okay, and you plan this kind of move, you plan it and you are prepared for it, trust me guys, you can hold on to trade. Just a single setup, you can hold it for a day or two, and the risk to reward ratio is going to be massive. Okay, so that is what, from experience, that is what I've come to understand in this market, that patience do pays in this market, guys. Patience is one thing, yeah, at the same time is a kind of a trader's weakness. Okay, most of us are not patient. We want to be doing something every time when we pull up the chart. Okay, so I'm telling you this right now, that you should take a break, step back, and learn to be patient. Okay, just wait, watch out for this kind of move. Okay, plan for this kind of trade. Okay, it happens every week. Okay, like I said in the first series of the how to frame our trade setup, I made mention that every trading week we have two major setups that form. Okay, and it forms every trading week. Okay, backtest this to whenever previous data time window you want. Okay, you can backtest it like previous 3 months, from previous 3 months, 5 months, 6 months. But trust me, this we have two major setups that forms every week. Okay, and this is just the setup, this is it right here. Okay, we have a counter trade setup and the main setups that goes in the buyer's direction. Okay, so if you are patient enough, this is what you going to be capitalizing on. Okay, and these are explosive move. We are not looking at a minimum of 3 to 1. We are no longer looking at 3 to 1 minimum risk reward ratio. Okay, we are looking at something like 5, 8, 9, 10, 12. Okay, so the idea is I'm learning to be patient myself. Okay, because it's not easy. It's one thing to wait for this trade before it happens. Okay, it's another thing to see it after it had happened. Okay, so the main idea is to wait and see it and capitalize on it before it happens. Okay, that is when you can really make profit. Okay, when you are good at looking at it after it happens, you can only read it after it happens. trust me, that is not something we only want to be able to do. Okay, we want to be able to look at this market and tell when something. What I'm doing is trying to help you filter it down. Okay, filter it down, and you should know what to expect, how to plan your trade. That's just what I'm trying to do here. Okay, I'm sorry for from deviating from the course of this video. Okay, but I just wanted to make sure we are clear on it. Okay, so now, well, the next thing we want to wait, or what we want to do with the 15-minute time frame. Okay, so this is where our counter trade setups comes in. Okay, so as I spoke about the two type of setup that forms every week, right? So this is the first one that always forms is the counter trade setup. Okay, most of the time I'm not saying it's accurate, but with what I've seen so far, the counter trade setup always tends to form before the main setups comes into play. Okay, so why is that? Because the move, looking, judging from what we see on the time frame, from the 1 hour time frame, this will be our consolidation, right? So this will be our expansion. Okay, so the expansion, the retracement is going to trade back up as a draw on liquidity to the 1 hour displacement. This right here, the retracement, is the counter trade setup. Okay, so there's expansion, and we always know after an expansion, the next phase we always go into is retracement, right? So that is why the retracement is what forms the counter trade setups in any, doesn't matter, irrelevant of it doesn't matter the bias you are having. Okay, so the counter trade setup is always going to form, in the sense that once we had an expansion, the next phase we always go to is retracement, and that retracement is what forms is what brings about the counter trade setup. Okay, so that is just that. So once we have our displacement on the 1 hour time frame, we drop down to the 15-minute time frame for our counter trade setup. Okay, so what I want to do with it is that I want you to wait for a shift in market structure. Okay, but the rule, so listening, I'm giving you this trading plan with rules. Okay, but the rule is that there must be a level on the 1 hour time frame as a drawn liquidity. Okay, in form of a displacement. Okay, so I want you to take note of these rules. Okay, so this is what sets the table for a counter trade setups. Okay, so if there's no expansion in form of a displacement like this, okay, there is never going to be a trade setup for us. Okay, so we just move on, to the next pair. If there's nothing like this in the marketplace, okay, when we think about this, just like ICT explained with the pool. Okay, when we have a children's pool and an elephant steps inside of the pool, it's going to create a huge splash. The water is going to run over, and creating a displacement. That's basically what is here. So what is basically, we are basically thinking of the consolidation as a pool of water, as that little children's pool. Okay, so when the elephant steps into that pool and creates the splashes, okay, the water runs over the pool and creating splashes. That is what is basically happening here. So this is the elephant stepping into this little pool, this little children's pool. Okay, so these are smart money, huge traders with deep pockets stepping into the marketplace, so creating these splashes. So these splashes right here, there must be, so there must be splash in price. Okay, am I going to put it, just using that term? Okay, I'm trying to create the term for us to understand it basically. So there must be this is what sets the table for us. Okay, this is what sets the tide. So without this, we have no trade setup basically. Okay, so we just move on to the next pair or whatsoever. So now we wait for a shift in market structure. So let's see if we have a shift in market structure to that will indicate to us that price is going into a retracement phase. Okay, so let's take a look at that from the 15-minute chart. Okay, so we had this. So this is our shift in market structure right here. Okay, you can see price expanded and took out. This was the last high that broke this low, and at the same time took out this relatively equal lows. Okay, so this is sell side liquidity being run out. Okay, so and price shifted the structure to the upside. So now what we have to do is to look at this price leg. If there's a displacement, is there a fair value gap in it? So I promised, I promised us I was going to talk about the difference between fair value gap and imbalance. Okay, that's going to be a topic for another time. Okay, so we had this fair value gap. Okay, so we mark that out in time and we wait. Okay, we wait for price to come back to this level. So this is where it gets tricky, guys. So there are going to be time price is going to come back immediately to this fair value gap. Then there are going to be some other times, as we can see here, that price is going to move going to move massively away. Sometimes it's going to be massive, sometimes it's going to be it's going to be sloppy, as we can see here, but most of the time it tends to come back to the fair value gap, to that fair value gap. Okay, so when we see this kind of movement away from this fair value gap without price showing the willingness to come back to it, sometimes we lose interest in the trade. Okay, that's that's trader psychology. Okay, but there are going to be other times that we are going to have massive movement or sloppy movement like this away from that point of interest on the on the 15-minute time frame. But number of times it's going to come back, some other times it will not. It will just create another kind of displacement to offer us a setup at the higher level. Okay, but there are going to be sometimes it's probably going to come back to it. Okay, so as we can see, price uh moved away, then eventually came back to it. So we drop down to our lower time frame. So the next time frame I'm going to drop that on is probably a 55-minute chart. Okay, so now you can see we had this. That is our shift in market structure, right? And we had sorry, this is our 15-minute fair value gap, right? So price drops into it, and as you can see, this is we have this range from this high to this low. So why not use this range? Why not use this range as our shift in market structure? I'll get to that as we go down further. Okay, but here is my shift in market structure. Okay, depending on the approach I'm using for depending on what I'm looking at. Okay, I'm looking at two things here. I'm looking at either a for a fair value for a failure swing, I I make use of smart money SMT divergence as more added confluence, okay, to come for a confirmation entry. Okay, so whenever I see a failure swing, I always look out for an SMT divergence. So I added that in this video, and we're going to get to that. Okay, but for now, this is our shift in market structure right here. Okay, so as you can see, if you take a good look at this price leg from this low to this high, we had this fair value gap, right? And we also have this fair value gap. Okay, so we have 2 points of interest. Okay, so normally it would be a some like the right thing to do would be to watch price to come back down to the fair value gap, to this fair value gap. Okay, because this will probably be at discount below the 50% midpoint. Okay, but I've come to realize that some of the time price is going to respect fair value gap, and I'm going to tell us the reason why it should respect fair value gap even without reaching into discount or premium. It should respect any fair value gap when we come to the series on fair value gap versus an imbalance. Okay, so we're going to talk about that. So let's go down further. So this is our shift in market structure, and we have this fair value gap right here. Okay, so this was my entry on this candle right there. Immediately we had the fair value gap, price traded into it. That's my entry right there, and my stop loss is below this low, so which is obviously what we see here. Okay, so where is going to be my target? Where is going to be your target? In this case, the target what we are hoping to reach for is our drawn liquidity from the 1 hour time frame, which is that fair value gap. Okay, so the lower part of that fair value gap is our exit. Okay, so let's see. As you can see right here, okay, so we got in there and got at, just look at the risk to reward ratio. That's a 6-to-1 risk reward ratio. Okay, so that is basically what I was trying to say the other time. Okay, so if we are patient enough to wait for this kind of setups, the returns are going to be massive. Okay, we are not going to be looking at just only a minimum of 3-to-1. We are going to be looking at more than 3-to-1 risk to reward ratio. Okay, so let's look at what I meant by adding more confluence if I come across a failure swing. Okay, so whenever I had a failure swing, as you can see here, I look for a pair that is correlated to this Australian dollar. Okay, a pair in that case, in this case, if I'm looking at a pair that I know has another pair that is closely correlated, that is when I look for an SMT divergence type. So you GBP USD and the Aussie dollar tends to move in tandem. Okay, they are closely correlated. Okay, so in this case you can see we made a low, which is obviously this low. Okay, then we failed to make a lower low, but you can see Aussie dollar GBP USD making a lower low, but and the Australian dollar failed to make a lower low. Instead it made a higher high. Okay, so what does it tells us? Okay, it tells us that the Australian dollar is probably being highly accumulated while the GBP USD is being distributed. Okay, so this is being accumulated and this is being distributed. Okay, so that is just it. So this is bought on strength and this is sold on weakness. Okay, so so this is what will make me to use this as my shift in market structure. Okay, so this is what will make me to use this as my shift in market structure. Okay, so without this I will be looking at this high. That's just basically what I mean. Okay, so let's go down. Now we have gotten to our point of interest.